Good evening, everyone. Welcome to today's live webinar on SEBI LODR, Elevating Governance and Driving Sustainable Growth. We are delighted to have all of you with us today for this focused session on practical aspects of SEBI LODR. It is my pleasure to extend a warm welcome to our Chairman, Sir, CA Babu Ibrahim, in absentia, our Vice Chairperson, CA Preeti Savla, and our faculty for today, CA Kuldeep Kothari, and moderator, CA Harsh Lalit Soni. We are honored to have all of you with us today. I would now request Chairman Sir to kindly address the participants and formally open the session. Over to you, sir.
Good evening to all of you. Very learned speaker of the day, Kuldeep Kothari, moderator Harish Soni, and Secretary CLCGC Seema Jankit, and I think the Vice Chairperson Preeti Savla from Mumbai is expected to join us. Thank you very much for joining us on this webinar. Today we are going to discuss one of the important topic on SEBI LODR, Listing Obligations and Disclosure Requirements Regulations 2015, and which is commonly referred as the LODR regulations, which forms the backbone of the corporate governance of listed entities in India. The primary objective of SEBI LODR is to ensure transparency, accountability, and timely disclosure of material information to investors and the capital market. These regulations consolidate multiple earlier listing agreements into a single principle-based framework, thereby bringing clarity and uniformity in compliance requirements. SEBI LODR places a strong emphasis on corporate governance, mandating requirements relating to the composition of the board, independence of directors, functioning of audit and other committees, and protection of minority shareholders' interests. It reinforces the idea of good governance is not merely a legal obligation but a critical driver of investor confidence. Another key pillar of LODR is continuous disclosure. Listed entities are required to promptly disclose financial results, material events, related party transactions, and other price sensitive information. This ensures that all stakeholders have equal and timely access to information, thereby reducing information asymmetry in the market. Further, SEBI LODR aligns closely with the applicable accounting standards by mandating the submission of both standalone and consolidated financial results wherever applicable to present a true and fair view of the economic position of the entity. Regulation 33(3) of the LODR mandates that every listed entity shall submit consolidated financial results in addition to the standalone financial results. Consolidation is required where the listed entity has subsidiaries, associates, joint ventures as defined under applicable accounting standards. In essence, SEBI LODR represents SEBI's commitment to strengthening market discipline, enhancing transparency, and fostering trust in India's capital market. Effective compliance with these regulations is not just about avoiding penalties, but about upholding higher standards of professionalism and ethical conduct. As chartered accountants and auditors, we play a critical role in these matters. Therefore, I am sure today's session will help us to abreast our knowledge and also keep updated with the latest development in that. And Kuldeep ji is going to take us forward in the next 1 hour or so. Thank you. Thank you very much. And over to Kuldeep ji and Seema.
Thank you. Thank you so much, sir, for your words. I would now request our moderator, CA Harsh Soni, to introduce our speaker for today.
Good evening, everyone. It is my privilege to introduce our speaker for today, CA Kuldeep Kothari. CA Kuldeep Kothari is a fellow chartered accountant, company secretary, and law graduate, and an All India rank holder in both CA CS examinations. With over 13 years of experience, he has extensively advised listed entities on financial reporting frameworks, SEBI LODR compliance, integrated reporting, ESG advisory, and Indies. He is a co-founder of Edwin Advisory Private Limited and is empaneled with ICAI as a peer reviewer and technical reviewer with FRRB and TAQRB. He has also contributed significantly to the profession as an author, researcher, and keynote speaker on financial reporting and governance. We are confident that today's session will provide practical insights and regulatory perspectives drawn from real world experience. With this, I invite CA Kuldeep Kotari to share his views and set context for the today's session. Thank you.
Thank you, Hers, for such a warm introduction. I would like to place my thanks to the chair of the committee, Babu Abraham, sir. And I think, sir, you have made my job relatively easier by giving the brief about what is going to be discussed during the session. So I'll just have to elaborate on the topics which you have just suggested. And this, this explains that how experience speaks for itself. Thank you, sir, for very enlightening opening remarks. My special thanks to the secretary of the committee, Seema ma'am, and their whole team for such a smooth coordination. So I'll straight come to the topic as rightly said by our chairman that it is not just about compliance. SEBI LODR is more towards bringing in transparency and elevating the governance standard of Indian listed landscape, I would say. And when we are discussing the very important topic of what new has come in terms of listing obligation and disclosure requirement, I think you all will be very happy to know that we are celebrating the 10th anniversary of SEBI LODR. 10 years back in December 2015, SEBI LODR was introduced by clubbing various different provisions and regulations so as to make sure that the corporates are at ease in terms of complying with these regulations. And when we discuss, I would like to call it SEBI LODR 2.0. When we discuss this SEBI LODR 2.0, we are standing at a situation at a level where the government is discussing the new securities exchange code. So this new securities market code will consolidate three acts altogether aimed at bringing in more uniformity, bringing in, I would say, the ease of doing business around which all the amendments are being introduced in past 2.5 years in terms of listing obligation and disclosure requirements, I would say. So when you talk about SEBI LODR, you have to segregate it in two parts. The journey started in 2015. I'll not take much time about discussing what has happened in past because we are discussing something which is the future. So you'll have to segregate LODR in two parts to understand it properly. And without understanding the base, I feel that it will not be appropriate us to go to something which is very technical and which is very, I would say, advanced. So prior to 2023, there were changes, regulations were there. They were, being amended time to time as and when it was required. But then came in 2023 SEBI LODR second regulation amendment, and I would say it has completely and drastically changed the whole landscape, as I would like to call it. It it is a roller coaster ride, I would say, on which we all are traveling since last 2.5 years. And the regulator is very proactive in terms of looking at the market, taking the practical feedbacks, issuing consultation paper. I would say every week there is one or two consultation paper which are being floated by the regulator for public comments, because see how it flows. Somebody will say that it is a one-way communication which is happening, but it is not the case. It is not a one-way communication. Before any regulation is notified, before it is approved in the SEBI's board meeting, before a proper consultation paper is floated, there is a lot of research and background working which is being done by the regulator in terms of bringing out a change. So how it starts? So there will be an internal discussion with the stakeholders. Then after the internal discussion, there will be a consultation paper which will be floated for public comments. Post the consultation paper is floated, they'll give you time to share your comments, and that's what we do from our institute side. Also from ICA side, various committees do provide their inputs in terms of governance, in terms of sustainability, in terms of market requirements, as to whether a regulation which is proposed is practically fitting into the scheme of things which the market is requiring the regulator to enact. And then post the public comments, there will be an internal discussion again, and then the proposed, I would say, changes in the regulations, or if any new regulation is going to be proposed, there will be amendments in the regulation based on the feedback received from the various stakeholders. And then it is approved in the board meeting of SEBI, and then it is notified. So it is a very expensive process which the regulator adopts in terms of putting in any new regulation, any sort of change. So before we think or we say that, see how it has come, we don't know what is the relevance, how it has come, whether it is going to be apt for the market. There might be a case that something is favorable in terms of approach to a certain set of entities and something is not favorable. But it is not the case that it is unthought of, it is not researched. They do extensively, they do research. There is market feasibility which is also studied. There is feedback mechanism in form of consultation paper, and after that also, see, uh, we have seen the same thing in case of related party transactions. So when you segregate the SEBI LODR 2.0 from SEBI LODR, the earlier one, then also 2.0 has two parts to it. Prior to 17th of May 2024, when the first reforms were completely enacted, and there was some back and fro which took place, and then from 17th of May 2024, we are on a different sort of journey, in which in past, I would say, 7 to 8 months or a year or so, we are discussing that what is to be done with related party transactions. So related party transactions, I would say, is something is of very significant importance, and it is what has impacted the governance image of the listed as well as unlisted entities in terms of Indian context as well as globally. So when you talk about related party transaction, in nutshell, because we all are chartered accountants, we understand and we do apply the same in terms of accounting, in terms of preparing financial statement, in terms of calculating the arm's length price, in terms of disclosure of related party transactions as per Ind AS 18 also. But when it comes to SEBI LODR, when it comes to procedural or strategic level implementation, I would say there was a clear need of the amendments which has been brought into place by the regulator. But having said so, why I took this, I would say, slightly technical topic in beginning, just to make sure that you understand that if any amendment is taking place, the feedback mechanism is ongoing. So it will not stop at the point where it is notified. So what happened in the case of amended related party transactions? It was notified that a certain set of information or minimum information which is required to be furnished for related party transaction, and there was a, I would say, a complete hue and cry in the market since last more than 1.5 year. People were discussing, corporates were very I would say in a tense situation. The compliance teams were in a tense situation that how do we comply with the same. It has become very, very difficult at that time. So why it became difficult? So if you compare that, earlier for a transaction, if it is to be approved by the audit committee or by the board or by the shareholder, if 2 pages were required to be furnished in terms of what information you are going to place on the table for approval, it was drastically increased to say 30, 40 odd pages, and then very technical information. So then there were many rounds of feedbacks, many changes were made. ISF, that is Industry Standard Forum, which is an forum, I would say, supervised by SEBI, but it is all the industry associations such as SOCHM, FICCI, and CIR part of this particular ISF, which has been given the responsibility to, I would say, make sure the interpretation of the regulation which are brought into place in terms of ease of doing business, in terms of elevating the governance standard, in terms of making sure that the Indian entities are on a long-term value creation path. So their job is to interpret the particular framework or particular notification issued by the regulator and come out with, I would say, implementation guidance So for related party transaction, they came out with first ISF note. Then it was seen that it is very, 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 I would say, compliance heavy in terms of what is required to be complied with. Then there was a round two which has happened. The implementation was deferred to say 1st April 2025 to July 2025. Then it was deferred to 1st September 2025, and now the amended, I would say amended to amended second amended regulation were notified on 19th of November 2025, giving a 30 days timeline, meaning which that from 19th of December 2025, now the amended RPT regulation framework is in place. Having said this, if you ask me whether on personal note I am happy with what has happened, with due respect, the answer will be no. Because see, what has happened to the RPT disclosure framework or the amendment which was initially thought of, to some extent, some would disagree to this, that it is kind of a simplification of what was required to be done. But I would say you can call it on the other side also that the intent with which it started is slightly, it has been diluted. Now it has been simplified, but the purpose of making those changes in the very first instance was not to just make sure that you amend something which is very simple, but along with simplification, the intent was to capture the information and to make sure that, as our chairman sir has said, that there is no asymmetry of information in terms of what is available with a set of shareholder, with a set of stakeholders, vis-a-vis what is available with normal stakeholders. So having said this, we'll try to cover in today's session what new has happened in terms of SEBI LODR regulations, because there is no point in playing the same tape again and again, that what has happened in regulation 30, 12, 24 or 30 rule or whatever it is. But the point is to see what is practical aspect to what has been introduced in terms of new regulation. Second is, when you talk about driving sustainable growth, I would like to highlight that BRSR, in form of making sure that the reporting, non-financial reporting per se, for Indian listed entities is at mark. Reason being, see, BRSR, as you call, in short form, it is BRSR, but it is business responsibility and sustainability reporting. Part of SEBI LODR regulation, and it has been one of the main areas where SEBI has made drastic changes, because the world is looking forward towards, I would say, making sure that the industry do grow, but it grows along with the environment without harming the other causes, the ESG factors. Governance, I think, it is the main foundational stone of putting up any regulation, any norm, any framework, any notification by whatsoever regulator, because governance is at the heart of what you do in terms of regulators' perspective. But in terms of sustainable growth, I would say BRSR has played a very pivotal role in context of Indian corporates. I would say, when you talk about BRSR is a mix of various international regulations also. When it was thought of, other international frameworks such as TCFD, CDP, such as IFRS S1 and S2, I would say the related part has also been incorporated in some extent, not completely, but in some extent, and we are on the path of aligning our reporting framework to the global frameworks. Then integrated reporting is also a very important international framework. Then GRI, so on and so forth. There are many international reporting standards in terms of how do an entity disclose non-financial data. But BRSR is, I would say, a compilation of all. BRSR is divided into three parts, and there was a very important amendment in BRSR also, along with the roller coaster ride that we started in 2023 in terms of SEBI LODR. It was implementation of BRSR core. BRSR core was a subset of, I would say, nine core attributes of various nine principles. Nine core attributes are there in BRSR core. And then to strengthen the market's confidence in BRSR or in sustainability related disclosures, the government said, the regulator said that let's put in, I would say, an external review in form of reasonable assurance, staggered manner. First, it was done for 150 entities by market cap. Then it was extended to 250. And now for this year, it was for 500 entities by market capitalization. Having said this, again, this assurance facet is on one side, it is very interesting. It is very exciting in terms of what practice it will, I would say, bring into place. But on the other side, again, still it is not regulated to that extent. Whether a chartered accountant is eligible to do an BRSR assurance or assurance on non-financial data, the answer is yes, because SEBI says that we want to keep the reasonable assurance oblique limited assessment. We'll discuss in detail if we have time in the end. They would like to keep it sector agnostic, profession agnostic, means that other person also can do in BRSR assurance work or a reasonable assurance or limited assurance work for non-financial data. But what it brings on table for chartered accountants, I would like to discuss that. It brings on table a very, very, very wide opportunity in terms of how do we conduct ourselves in terms of expanding our practice in coming next 3 to 5 years. The path is open, and I would say there's no looking back in terms of why I feel that a chartered accountant is the most suitable person or most suitable professional to provide an assurance or an overview on non-financial data, because ethics, integrity, independence, governance, we all have learned this throughout our life, throughout the time we have studied, and we are the, I believe personally that we are the best suited professionals to do this job. We'll discuss in detail in later part of the presentation that how an assurance is to be given, what type of standards are applicable in terms of uh, assurance on non-financial data. Are there any assurance standards issued by the institute? The answer is yes. A separate board, sustainability board, is looking after the same. Are there any international standards? The answer is yes. As to what level we are converging with the international standard and where we are standing, we'll try to touch upon all the topics. But let's start with the main topic of the day, which is SEBI LODR and what new has happened. As we discussed, that the second part of this LODR 2.0 started in May 2024 with implementation of, or rolling out new guidelines for disclosures of market rumors, material information. Then we straight away, before, in between December and May 24, there were some amendments pertaining to, say, as to at what interval a meeting of risk management committees to be required to be taken place. Then some sort of, I would say, relaxation in terms of the time allowed for filling up the vacancies of KMPs in terms of a statutory approval if it is required in specific cases. But those were not that material relevant. Then came the second step. The notification came in terms of the prohibition of insider trading, which has been again a very, very sensitive topic, I would say, and very talked upon or very discussed upon subject when it comes to SEBI, when it comes to conduct of corporate entities, when it comes to governance, along with the related party transaction. Then in December 2024, the ISF issued an guidance note as to how BRSR core or BRSR is to be, I would say, applied in terms of various different entities. Having said this, what is my personal take? You go back, if any one of you and I believe that many of you will be working and are working in and around the listed entities. You go back and read this ISF note on BRSR core or BRSR, I would say, whether it is comprehensive enough. Maybe in one sense it is comprehensive, but on the other side it is not. See why I am saying so. So from the approach that one size fits for all, we have to come an approach where we can say that customize for shorter and tall. So it is not that everything is applicable on everyone. When you say that ISF on BRSR, there has to be some sectoral, I would say, classification in terms of what is to be applied in what sense. So take one such hypothetical example. They suggested that I would say, from an approach where you capture the data in real terms, in terms of water, waste, energy, or emissions, GHG emissions, you can take a spend-based approach also when it is not feasible or it is not possible to capture the data in the correct manner, or you can do extrapolation of data also. So when you say extrapolation of data, there is a guidance which says that how do I calculate my water consumption. So if it is a service industry, it becomes very, very difficult, I would say. Practically it is very difficult, because either you are operating in some cases from leased premises. Even if the water meters are installed, the kind of monitoring in case of a service industry for water and waste is not that, I would say, it is not up to that level. So what do I do in that case? So they suggested that as per the CPWD's guidelines, sorry, CPB's guidelines, you can say that you can take an hypothetical figure of 45 liters a day for every individual. Then there is an additional factoring of 80% also. But this 80% factoring of, say, for example, if you have 100 odd people working in your organization, or 200 of your 500 odd people working in your organization, to calculate the water consumption, you will take in 45 liters a day for a person, and then you will calculate, multiply it with your number of employees. And then there is an additional factoring which is being done by the entities, which is taking the 80% portion of the figure which has been arrived after putting 45 liters to the number of employees. But whether it is written in the ISF note, the answer is no. So they say that you can take spend based approach in case of calculating the energy related data also, but whether it will be correct or not, the answer is still uncertain. You take an example where a bank, say a bank of the state bank size, is trying to capture the data for all, say, 12, 13 or 14 odd 14,000 odd branches. Whether it is practically feasible, the answer is no, because the branches may be at a remotest of location, and there may be a case that if you put even tech at every place, it will not be feasible in terms of the costing also. So what do I do in that this case? Extrapolation is something which is left in front of me to arrive at a data which is not, I would say, accurate to 100%, but still it is accurate to a certain extent, wherein I can make sure that my assurer have a trust on the data which I am giving. Because ultimately, before putting it in the BRSR, if I am under that bracket of reasonable oblique limited assessment or reasonable assurance, I'll have to make sure that the assurer is on the same page from where I'm coming from. And then second, I'll have to make sure that the investors or the readers of financial statement do get that confidence in terms of what I'm giving. So that's why you will see a variety of data being represented in various sectors, various companies, and there is a huge deviation also. And that's where we say that in terms of any ISF, so the job of ISF is to make sure that the interpretation of any notification, regulation, or framework is in the rightest manner and is aligned to the intention of regulator, as well as practically fit for the entity also, based on the sector. So sectoral guidance, I think, is still expected even after 1.5 year of this ISF note. Then an entity, then a recommendation committee was formed for ease of doing business. They've given the recommendation. Then started from February 2025. Again, we are coming back to the RPT part. So you, just for the sake of knowledge, if you want to write it down, you go back to February 2025 and you see that minimum information is required, which is required to be provided for approval of related party transaction. You will be, you will, grab your heads and say, "Ki, what is this?" There is a upside down change which has happened. And initially, when it came, we said that it is not practically doable. Let's put something which is practically doable. Second, which is aligned with the, again, reiterating the same thing, which is aligned with the regulator's intent and which is aligned with the practical aspects of that specific sector and the entity also. Then in February 25, a very, I would say, welcome change which has been brought in by the regulator in terms of putting up standardized KPIs for any entity which is going public or which is coming up with a follow-on public offer, I would say. So if you are going to secondary, if you are going to primary market for raising money, so there were, I would say, a certain need of this specific change. So when you say KPI, KPIs are key performance indicator. This is the literal meaning of this word KPI. But what it means, it is very important. So in terms of your financial, in terms of your non-financial data, KPIs are something which every reader or every investor will look up to. Say, if you say, what is the point of like putting up specific ratios? What is the point of, say, if somebody is saying that my top line is growing by this much of percentage, in particular, if I have three business segments, in one segment it is growing by this much of percentage, on the other business segment maybe it is going down, or maybe it is static. The trend in terms of my bottom line is this. The trend in terms of my R&D expenditure is this. Hypothetically, the trend in terms of the units which I've sold, if it is in it is in company in which the sector in which it is operating, is, I would say, more the parameter to evaluate the performance is more about how many units you have sold. If the KPI is that, see, have reached to a certain level of number of consumers, or maybe certain level of customers, or average revenue per customer, there can be n number of indicators which may be used by an entity, but there was no uniformity, I would say. X, Y, Z were disclosing the same as an how it was fitting into the scheme of things for the respective entities. And now SEBI is standardized that as how in KPI is required to be identified when it is going, the entity is going to public in IPO's case, or if it is an FPO's case. The identification process, the basis of identification as well as disclosure, and then there is a need, I would say, interpreted need, that in a KPI, if disclosed, it should be one that it can be disclosed consistently over a short, medium to long period of time. I would say at least 2 to 3 years. It should be consistent enough so that the readers of the financial statement of the stakeholders are able to compare that what was there in the last year or maybe last report, what is there in the present report. So, having said this, why KPIs are very important when you see annual reports or integrated annual reports of large listed entities? You see value creation model, you see business overview page, you see initial 10-15 pages are filled with, I would say, certain set of qualitative and quantitative information in terms of how the business is doing, where the entity is traveling to, and what is the intent and what is the vision of the management or vision of the company where they want to reach. So in terms of qualitative and quantitative information, a certain set of KPIs are identified. they have to be sectoral KPIs. Then you talk about value creation. Value creation is such a thing that ideally what it should reflect: value created, value preserved, and value eroded. So value created and preserved, how would you say that my top line is growing by say 15 odd percentage every year? This is in a sense a value creation parameter for the investors, so for the stakeholders. Value preserved, that though I was not the entity was not able to add on in terms of the growth in bottom line, but it is static, it has not gone down, but it has remained to a certain extent, then it is value preserved. But in case of value erosion, there may be a case that one KPI is not fitting in the scheme of a upward trend or a static trend. It may be going down. That in terms of, I would say, margins, the margins are down, yet the top line is going up. So there may be a case that the sale has increased, the profit is static, but the margins are down. So the ideally intent of any entity should be that they reflect the value created, preserved, and eroded, and on a consistent basis. That is, at least for 2 to 3 years, the KPIs should be in the same line. Then Regulation 30, which was the talk of town, and which was the which I would say it was the initial seat of the roller coaster ride of SEBI LODR 2.0. Regulation 30, everybody and anybody was making different sort of interpretation in terms of how it is to be applied. As simple as that if when you say what is materiality threshold, so they introduce a concept of 2 to 5. So 2 to 5, there was no quantitative threshold earlier, but then they introduced this concept of 2 to 5, that 2% of my turnover, 2% of my net worth, that is absolute net worth, then 5% of my average profits. What happened? Then there was a question, as we do like to question, and the mind likes to question in any case, that what do you understand by net worth? Then they explained that it is absolute net worth. That in case of I would say negative net worth, it is not required to be added, but you have to skip the same. What is profit? It is absolute number. That if there is loss or if there is profit, then the both things are required to be added along to arrive at the average figure. When it is about turnover, it was very simple that the turnover will be turnover. But then again, the question rose that how do I compare an event to this 2 to 5 figure? So they say that the materiality threshold will be lower of the following: 2% of the turnover, 2% of the net worth, and 5% of the profits. And you can very well go backwards and check on our previous lectures also. And I think we had a program with the same committee a year back also. I said at that time in 2023 also that Apple is to be compared with Apple. The rule of comparability has to be brought into place, because you can't compare anything which is not in line with the specific uh, underlying denominator. So why I would say so? So there might be a case that a transaction or a material event is primarily hitting your or is going to take a hit on your bottom line, or maybe impacting the bottom line, I would say, or maybe impacting the top line. So if I compare lower of these three parameters, then in that case, what will happen? Then in that case, what will happen? Uh, it will give false results in almost every case. So there might be a case that if I am having an asset light model, my net worth is less. So what I'll do, I'll put at the lower of three, that is 2% of the net worth figure. And then if I'm comparing any material event which is going to have an impact on my top line, then the expected impact in terms of value, if it is not quantifiable directly, will always be higher than the lower of these three parameters. So there were many questions as to whether I can aggregate various sort of litigations, What do I do? So whether materiality means that I have to disclose each and everything, whether I'll have to disclose each and every text notice, and you will be surprised to know if someone is new to this topic that you go to NSC or BSC's website, you see corporate announcement page, then you see regulation 30. Out of 10, out of 10, more than 80-85% of the disclosures are pertaining to XYZ type of tax demands, tax notice, or maybe figures which were very minuscule in absolute amount, which in either case wouldn't have any sort of impact on the entity's business, or I would say entity's financial standout. But still, see, to be on the safer side, saying is rather easier than doing. So if I'm on the other side of the table, I'm complying with what the regulator has asked me to do, so I'll do what is required to make me on the safer side, and they did the same. Every A to Z, everything was disclosed. And then where we said that the materiality has been taken over by triviality. So in this, I would say, stack of XYZ litigation or tax related regulation 30 disclosures, maybe in some cases, the important material disclosures were buried down. So, to answer all these questions in 2025, ISF came out with an, I would say, guidance or implementation guidance in terms of as to how an individual regulation 30 requirement is to be interpreted. Though it was slightly late in terms of, because we started in June 2023, June 2024, June 2025. So almost after 2 years, they came up with this particular piece of advice, but still it is helpful. Then the revised RPT framework came into June 2025, which was supposed to be made effective from 1st September 25. And as I said in the beginning, that from 1st September, what has happened after this? On 12th of September, the same set of ease of doing business related amendments were approved by SEBI board on 12th of September. Then it was notified on 19th of November 2025, and it was effective post 30 days of notification, meaning by which, as I said in the beginning, from 19th of December 2025, the revised norms, which are relatively easier to comply with, which are simple in every manner, which are, I would say, not as complex as they were thought of in the beginning, are in place. And this whole journey of identifying related party transaction, or maybe transactions which involves promoters, promoter groups, promoter entities, subsidiaries, started in 2021. So 4 years back started. The implication which we saw as a market, and everybody woke up in 2023 when the last phase of the implementation was to be done in case of the revised norms. And then it was a widely debated topic as to what is to be done, how it is to be shown, whether the amendments which have been brought in terms of how you deal with your material subsidiaries or promoter groups or promoter group entities or related parties are correct or not. So it has been a 4 year journey, more than 4.5 years it has taken us to reach to the level where we are standing from 19th of December 2025. In some sense, as I said in beginning, it may be interpreted as an ease of doing business, but in other sense, I would say personally, it is not an official statement that it tantamounts to dilution of the intent, what was thought of in the very beginning. In terms of, say, as of now, in the revised framework, the upper limit is 5,000 crore for an entity whose turnover is crossing 40,000 crore. There is a staggered approach as to what is to be taken as a criteria for a material related party transaction. But still, 5,000 crore is something which is a very, very huge amount. It shouldn't have been done, but it is done. And you see a report which is available online also, which suggests that there is a substantial decrease in terms of the number of material related party transactions placed for approval on the table in front of the audit committee and shareholders for top 50 Nifty entities or top 50 entities by market cap. So it has drastically come down from I think somewhere around more than 200 to 93 or 94. I don't remember the number exactly, but it has drastically come down in terms of the number of uh, transactions put into place for related approvals. Then Then what forms the basis? Our chairman sir has rightly said in the beginning itself that transparency, governance, and asymmetry of information is the basis of each and every change which the regulator is coming up with in terms of LODR regulations. And even in the case when you see the recently tabled Securities Market Code SMC 2025, it is also comprising or it is also based on the same principles. So I'll not discuss this in interest of time. I'll go regulation by regulation, starting from 6, then 23, 29, 30, and then 33 and all. So what has happened? This might not impact, I would say, private entities in a larger level, but in case of various public sector undertakings and other private entities, also not bigger ones, but mid to, I would say, small cap segment, it has an impact. Earlier, there was no such segregation that who can be in compliance officer. Obviously, it will be in company secretary, but designated compliance officer and I would say company secretary. In some cases, it used to be one and same, but now they've said that it has to be a different individual who is a compliance officer and who is a company secretary, designated company secretary. They will be they have to be engaged on a whole time basis, designated in KMP, and having been designated as a key managerial person is something which is very important in terms of the new regulation interpretation of the new regulation 30 requirements. Now they say that the requirement for a full-time company secretary in KMP designation was largely in line with the prevailing practices. It was there, but with certain tweaks and changes. However, the phrase which they have introduced and which has, I would say, a slightly bigger implication in terms of public sector undertakings as far as my research of the market is concerned. That is, the compliance officer or company secretary has to be a officer or I would say a KMP, not more than a level below the board's designation. So ideally, it will sit into, I would say, something 8 or 9 level of the CXO category, and this has created slightly a different sort of, I would say, problems in terms of implementation for public sector undertakings. Not that problematic for the private sector undertakings, but it has an wide and vast impact in terms of what is to be done for the public sector undertakings. I'll skip this case study in terms of because it is available online also. In case of DCB Bank, the compliance officer was initially placed 5 levels below the board, reporting directly to the managing director and the CEO. But now, since the revised regulations are into place, it has to be a case that it is not more than a level below the managing director or the whole time directors, uh, comprehensively said as board. So this is the order. Now coming to the burning topic of the recent time, which is related party transaction. Regulation 30 is what is governing the related party transaction. Regulation 23 governs the approval, disclosures, and governance of related party transaction by listed entities. What it aims to bring transparency and prevent misuse of corporate resources by related parties. See, we have seen a lot of corporate fiascos in past 15 years, or more than 15 years or 20 years, I would say globally, as well as at the local level. I would not take the name individually, but what we have seen, uh, something drastic was required. And that's why I said in the beginning that when you amend something to a level, it starts losing out the intent, or it starts getting diluted. And this is what I feel that has happened in terms of the RPT norms. So what is a related party? As per LODR 2015, any person, any entity forming part of the promoter or promoter group of the company, any person or any entity, as I said that the you know working started from 2021, but the market talk or discussion started from 2023, when the last phase of this initial change which was brought in 2021 was supposed to be implemented. Any person or entity with effect from, it was, so since it is 2.5 years old, but still it is relevant, holding 10% of more equity shares of the company, either directly or on a beneficial interest basis, at any time during the immediate preceding financial year. So this was again something which created a lot of debate in market, that see, if at any point of the year the shareholding goes beyond 10%, then in that case I become a related party. I mean to say, the person becomes, or the entity becomes, a related entity, a related party in terms of the amended LODR regulation. So what do I have to do? The burden was more on, in terms of, say, the RPT, the related party, as well as the entity also, the reporting entity, in terms of to keep, have an eye on all transactions which are happening throughout the year. Because at any given day, if a party, if an entity, if an individual crosses the 10% threshold, it will become a related party. Then again, I said there was a lot of discussion about as to related parties of subsidiaries. So there may be a case that A Limited, B Limited, and C Limited. There are three entities. A is the holding entity, B is the subsidiary. Now C Limited is a related party of B Limited, which is a subsidiary of A Limited, and C Limited is entering into a transaction either with A, either with, I would say, D. So C and D both are unrelated parties for the holding entity, but yet they, under the amended norms, they will become a related party. Because if any transaction is taking place for the benefit of the holding entity, or maybe otherwise also the audit committee of the holding committee, if a transaction is crossing the certain threshold, which is earlier it was like 10% of the standalone turnover of the subsidiary. Now it has been amended. In present case, it is 10% of the standalone turnover of the subsidiary entity, or the materiality threshold of the holding entity. If it crosses any one of these two, then it will have to be placed before the audit committee of the holding company for the approval. So slightly complex, but I would say to break down the chain, it was required, and it is very well thought of, and it shouldn't have been and should not be diluted in any manner. So what do you understand by RPT framework, how it is being built? The governance part is, in, I would say, indispensable. The governance part is indispensable in terms of every regulation, specifically RPT or PIT. Governance forms the foundational stone of these regulations. Then what is the compliance framework? As of now, there are two or three type of oversights which are available. Certain set of transactions are required to be placed before audit committee for approval. Certain set of transactions are required to be placed before shareholders for approval. And the amended framework makes sure that there is an oversight of both direct, as as we all know, and indirect transactions, that is related party of a subsidiary entering into a transaction with any unrelated party for the benefit of the holding entity. These type of transactions are covered under the amended framework. So it covers the direct and indirect transactions, and it is applicable to the listed entity as well as the subsidiaries of the listed entities. Sorry, who falls within the net? Do we say that everybody and anybody is covered? The answer is no. Promoter group entities, even if they don't have any shareholding, they will be covered because of lately SEBI has amended the definition of, I would say, connected person as well as promoter group and promoter entities. Any person and entity, as we said, holding greater than equal to 10% of the shares of the entity at any point of time during the previous financial year will be covered, will fall within the net of related party transaction. And this requires a dynamic approach to as to capture the data in a manner that it can capture all the transaction and all the related party transactions. So, do I say that every deal will become a disclosure drill? The answer is no. It is not the case. But otherwise, also, whether I can say that everything is now simplified, the answer is no. So, in both cases, there is a very delicate balance which the regulator has maintained, and where the compliance button will be triggered. Where the compliance button will be triggered, so if it exceeds during the previous financial year 1,000 crore or 10% of the annual consolidated turnover, if it exceeds 1,000 crores or 10% of the annual consolidated turnover, based on the last audited financial statement, it will the compliance button will be triggered, and then in that case you'll have to it will have to be passed through different sort of lenses, different sort of tests as to where it is required to be approved, whether it is required to be approved by the audit committee, whether it is required to be approved by the shareholders. What is in terms of audit committee's approval for transactions of subsidiary? As I've already told in the beginning, that earlier it was, then this 1,010% of the annual consolidated turnover has also changed. I'll discuss in detail in the later part of the presentation. But in terms of audit committee approval for related party transactions of subsidiaries, 10% of the annual standalone turnover of the subsidiary, or the materiality threshold of the holding company. These two are to be taken care of when you identify any related party transaction. So how it went throughout last a year or so, 2025 February, SEBI came up with a circular introducing the minimum information required to be presented for approval of related party transaction, and simultaneously ISF came up with a note said that the initial implementation date is 1st April 2025. Then it was deferred to July 2025. Then it was deferred to September 2025. And then as I like to call it, RPT 2.0 was approved by SEBI's board on 12th of September 2025, which is effective from 19th of December 2025. And why it is so? Because it was notified on it was notified on November 2025, 19th November 2025, and it gives you 30 days to implement, to make sure that the regulations are effective. What has changed in terms of revised RPT standards as to when we compare it with what was there in April 2025? Let's not discuss in detail what was there in April 2025 or February 2025 because it has no relevance as of now. Let's discuss the key differences which are there. Earlier, there was a clause which says that in case of a related party transaction, you will have to you will have to present 3 years data of the related party. You have to analyze that. Now it is only a year or so. They expanded the transaction scope. Trade advances and performance guarantees are now explicitly covered. Earlier, it was not. Lighter royalty disclosures. For in case of royalty, earlier it was that if it is crossing a 5% threshold, it was required to be disclosed, and then in that case, you'll have to see what is your symmetrical peer. If they have entered into the same sort of transaction or not, local peers are available, then you'll have to go global in terms of making a comparison sheet. Now, these norms have been slightly relaxed. In relaxation on bids, credit relating disclosures is FXL bids. Earlier, it was minimum three. Now they have left to the management discretion, limited to the latest credit rating, which is now required to be disclosed. No benchmarking in terms of the credit rating is required to be disclosed or to be placed for RPT approvals. Wider exemptions by sector now. It includes insurance sector companies, housing finance companies. Earlier, it was related to NBFCs and banks. Reduced data for investment. Now, there is no longer need to disclose past returns in case of return on equity, asset liability mismatch, etc. So, there are certain set of relaxations which has taken place in terms of RPT transactions. The revised framework is slightly simpler, but yet I would say it has not been diluted to the level, but it has been simplified to a greater extent, making sure that it falls within the ease of doing business criteria. But having said this, else I'll maintain my stand of saying that initially what was thought of, it is not coming out as of now. So, what is being carved out of Regulation 23? So, when you say RPT, it is not about policing every rupee or every transaction, about identifying influence, benefit, or control. It places the spotlight where it matters. What is required to be seen, what is required to be evaluated, what is required to be put under the lens of oversight. It only targets the same area. Not everything is required. For example, transaction with a related party, individually or cumulatively, if it doesn't crosses the limit of rupee 1 crore, no approval or no, I would say, additional exercise is required. There is a concept of, I would say, there is a concept of omnibus approval also. Of what is omnibus approval? So, if a related party transaction is of a nature when it is a recurring one, so what do? Will you place each and every transaction for approval before audit committee, or if it is falling under the criteria of, say, shareholder approval bracket? The answer is no. You can get an omnibus approval, but can you do it for all recurring RPTs? The answer is no. So it only gives you the hindsight. It is not giving you the foresight, I would say. It because in case of omnibus approval, you only place the broader terms on related details for approval, but you are not placing the detailed terms on related details for approval. So not all recurring RPTs, the discretion is with the entity, but it has to be applied judicially to make sure that you don't put any sensitive recurring RPT under this omnibus approval route. And there is a, I would say, concept of quarterly review also by the audit committee for the earlier granted omnibus approvals. And now one more, I would say, aligning change which has come into place in terms of omnibus approval being valid from one AGM to other AGM. That is in line with the section 96 of Companies Act. And now omnibus approval granted will be valid from an AGM to the next AGM. We can skip this this also. So why I say that discretion has to be applied and has to be seen in judicious manner. You have to be very cautious when you are applying your discretion, because see, where the subjectivity is, there will be mismatch, there will be different sort of interpretation of same wording, same definition. So when the definition will end, if there is no literal definition or literal meaning given to a certain, I would say, transaction, a certain set of text. Say, for example, what is arm's length price? It is not defined in SEBI LODR. What is ordinary course of business? It is not defined in SEBI LODR. What will be the situation in case of a subsidiary if it is located within India or it is an overseas subsidiary? So there is lack of clarity as to what these all will mean. So there we have to apply our mind that in terms of generally accepted, as we do in audit also, generally accepted auditing principles or generally accepted accounting principles, what is to be done, what is the business prudence, what is the internal benchmarking, what is the third party view, and what the peers are doing. Every facet of this this has to be put in a single page, and then it is required to be seen from a single lens, that whether it falls within the ambit or whether it is not falling within the ambit. Then there is a very important, or I would say very different sort of test which is there, purpose and effect test. We will not discuss in detail because it will derail the today's topic. But purpose and effect. So when you talk about related party transactions, when you talk about Regulation 30, it is not only it is about assessing the quantitative transaction. It is not about assessing the transaction counterparty. So A is entering into a transaction with B. The intent of Regulation 30 is not as such that you will, you will test or you want to test the counterparty, but the intent is to assess what was the purpose, as to why this particular deal has taken place, as to why this particular transaction has been entered into place, whether it carries any sort of relevance, whether it was inevident for the entity to undertake this transaction, whether it has have any sort of business significance. Then, if the purpose is satisfied, then what is the effect of this particular transaction? What is the effect of this particular deal? So it is an holistic assessment which an entity is required to undertake for any RPT. Now, SEBI LODR 2.0 part second, RPT, I would say simplification or minimum information required for to be placed before audit committee for shareholder approvals. Now RPT 2.0 we are standing. We've already discussed. Let's discuss very quickly what are the threshold for material RPTs. So I was fortunate enough to be part of the group which suggested these staggered, or I would say linear set of criteria for identifying and material related party transaction. Earlier RPTs were considered material if they exceed 1,000 crore or 10% of the ACT. ACT is annual consolidated turnover, whichever is lower. And as I say, that earlier it was an approach which said that one size fits for all. Now they are going back to let's customize it for shorter and tall. That is scale based threshold and directly linked to turnover. Still, I would say that the capping of 5,000 crore or 3,000 crore or 2,000 crore is relatively higher. Still, attempt has been made to rationalize the threshold for identifying material related party transaction. So there are three thresholds which they have suggested, which is in place also from 19th of December 2025. If your turnover is up to 20,000 crores, then the minimum threshold is capped as 10% of the turnover, or 2,000 crore, it is lower of the same. So if your turnover is below 20,000 crore, say 15,000 crore, the capping or the quantitative bracket will be 1,500 crores, that is 10% of the turnover. If your turnover is between 20,000 to 40,000 crores, then in that case, the 2,000 crores is intact and 5% of the incremental turnover. So hypothetically, let's take an example. You are assessing or you are given the task to assess a material related party transaction for an entity whose turnover is 30,000 crores. So what will be the capping in terms of the quantitative threshold? It will be 2,000 crore. Fine. 5% of the next 10,000 crores, and which comes to 5% of 10,000 crores come to 500 crores. So 2,500 crores will be the capping in terms of identifying any material related party transaction. So for this bracket, the highest can be 3,000 crores, obviously, and above 40,000 crores, 3,000 crore is kept intact. Now, the 5%, which was down from the earlier 10%, now it has come down to 2.5% of the turnover over and above 40,000 crores. Because if I take the 5% cap for any entity whose turnover is more than 40,000 crore, then I may end up making the materiality threshold very high, which eventually which eventually mean that all the transactions will not fall within the net of the material related party transaction. So up to 40,000 crore, maximum is 3,000 crores. So take an hypothetical example. If an entity's turnover is say 60,000 crores, what will be the materiality threshold? It is 3,000 crore plus 2.5% of next 20,000 crore, which again comes to 500 crores. So it will be 3,500 crores, but it can go maximum to 5,000 crores. So, for example, if an entity's turnover is say 2 lakh crores, what will be the threshold if I apply this formula? 3,000 crore plus 160,000 crores multiplied by 2.5%, it will be somewhere around 8,000 crores, but they have kept the maximum ceiling at 5,000 crores. So they have divided this materiality identification threshold based on the scale, based on the turnover bracket for various entities. This is a welcome change, but I would say still suggest that a maximum capping of 5,000 crore is way slightly higher in terms of I would say any transaction not to be classified as a material related party transaction. We have already discussed that the threshold for material RPTs in case of subsidiaries, earlier it was only 10% of the standalone turnover of that subsidiary. Now it is lower of the 10% of the annual standalone turnover of the subsidiary and the material RPT threshold applicable to the holding entity. One more important amendment has happened, which says that if there is a subsidiary which is newly incorporated, then it will be difficult for me to have any prior standalone or prior turnover because it is a new incorporated subsidiary. So, what do I use in terms of in terms of having the threshold for the material related party transaction identification? And they said that use 10% of the aggregate of paid up capital, securities premium of the subsidiary, or materiality threshold applicable to the listed holding company. So in this case, no special track record or previous year's data, because they will not be available in case of a newly incorporated subsidiary. They are not required. We have discussed this shareholders omnibus approval in case of recurring RPTs. Now it is valid from a AGM to AGM. In case if it is approved, obtained in a AGM, and that is 1 year in line with the section 96. And whether we should use this route for all type of recurring RPTs, as I said, it should not be the case because it gives you the benefit of a hindsight only, not the foresight. So when you are getting an omnibus approval, why again I am reiterating, because it is again a very important aspect of related party transaction approvals, which is an omnibus approval route. You only place concise version of what the terms and limits or transactions are. So don't do it for all recurring RPTs, and neither it is suggested also. Earlier, though it was not intended to be, but I said as in terms of regulation 30, it has happened with related party also. See, if I am say a related party of an entity which is into a business in which it is consumer driven business. For example, I'm selling say TVs, if I'm selling say cars, if I'm selling say other products. So what will happen that as an individual, if I go to the store of that entity or maybe showroom of that particular entity to which I am a related party and I buy something, earlier when there was no distinction between as to what transactions will be covered, it was no, though the harmonious interpretation doesn't intended it to be, but it was covered. So now they've said that all the retail purchases made by the employees are excluded from the related party transactions. Similarly, if such transactions are undertaken by relatives of the directors or KMPs, were included to be considered as a related party transaction. So this was having an inconsistent treatment. So when you say employee buys something from, I would say I'm working in Mahindra or I'm working in Maruti, and if I go and buy a car from the showroom or car from the entity, it is not an that company owned dealership. If it is not an related party transaction. But if it is the other way around, that a director, relative of the director or KMP is going to buy this, then it becomes a related party transaction. So they excluded the same. Now, if there is any related party transaction which is happening between the holding entity and the wholly owned subsidiaries, then it is also exempted in terms of if the approval is required. But consequently, where an unlisted subsidiary enters into an RPT with its wholly owned subsidiary, the exemption will not apply. So, this exemption of RPT between a holding entity and wholly owned subsidiary is applicable only to the listed entities. So, if there is any unlisted subsidiary which is entering into an RPT with its wholly owned step down subsidiary, I would say so A, B, C. A is listed, B is not listed. B is entering into a transaction with C, which is a step down wholly owned subsidiary of B. This exemption will not apply. We'll skip this for the sake of. So these I'll not cover each and every individual uh, this breaches of what has happened in terms of RPTs, because it will not be appropriate to take the names on this forum. But this presentation will be made available if required through the committee to all of you, so that you can go through and what has happened. So in almost all cases, though the penalty is not appearing to be heavy, but SEBI has taken action in case of in case of in case of these related party transactions not fitting into the amended norms, a penalty of 2 lakhs, 3 lakhs, 25 lakhs, and so on and so forth. And what was the substance? The substance or compliance lesson that we can drive out of these real world examples, that in case of Karma Energies, there was a lack in terms of RPT policy. Approvals are mandatory before transactions. In case of Premier Polyfilms, the prior approvals and related party identification, I would say, is very critical facet to the whole framework. In case of Lens India Limited, the substance is beneficial outcomes of related party is triggering the compliance, that is indirect implication of a related party transaction. Now, what do we understand by UPSI? I'll cover this UPSI part, and if the time permits, I would like to cover it in 10 to 15 minutes. BRSR part also in the end. So, what is UPSI? UPSI is unpublished price sensitive information. So, if any information which is not available to the public, which is not yet in the public domain, officially in the public domain, or as they like to call it, it is not generally available, so it will become unpublished, relates to an company or its securities, and it is likely to affect the price of securities when it is made public, then it becomes an UPSI. So, essentials condition for an information to be identified or qualified as UPSI, that it has to satisfy both the condition. It should be unpublished, and it should be price sensitive also. If either of these conditions are absent, it will not be treated as an UPSI. Now, very important aspect which was not earlier that widely talked about, what is the meaning of generally available information. So regulation 21E defines that information that is accessible to the public on non-discretionary basis. The definition specifically exclude unverified events, information reported in print and electronic media, or any sort of vague or partial claims made by any of the KMPs or other part of the entities, uh, other members of the entities. And why it has become important? Why it has become important is because there was a very important judgment which has come on 2nd of December. The Honorable Supreme Court, in case of the largest corporate conglomerate of India, has upholded the penalty of 30 lakhs, which was imposed by the regulator. The transaction pertains to the COVID period, in which there was a strategic tie-up or joint venture which was disclosed. So when the news leaked in the media, the the price fluctuation was approximately 15%. When it was officially introduced, like after a day or two, the price fluctuation was less than 10% in that case. So it clearly stated that you can't say that a leak which has happened in media, it will qualify for generally available information. So the impact of the leak in media was way higher than the impact of uh, official announcement by the entity in terms of the share price movement. So this honorable court has upholded the penalty of 30 lakhs on this particular entity. But again, there was a order of SET which was published on 12th of December 2025, which is in quasi judicial body. Uh, it it is completely different from what the apex court has said in its judgment dated 2nd of December 2025. So the issues were slightly symmetrical, in which there was an allegation of leakage of UPSI. There was an allegation of trading taken place while you being in possession or the party being in possession of the UPSI. And the allegation was pertaining to, or the UPSI was pertaining to, acquisition of a company leading to a significant enhancement in terms of operational capacity. A lot take the name. So the respondent said that in bits and pieces, the information was made available. It was leaked by the media. It was available in print and public media. So it became in generally available information. And to our surprise, just after 10 days of the order of the apex court, the QJC, the quasi judicial body of SEBI, that is SET, has accepted this verdicts. And they said in their finding, and it is very important to read, I'm reading it for you. The information had entered the public domain through media reports. The information was available on a non discretionary basis. Accordingly, the information ceased to be UPSI after publication of such reports, and charges against the company were dropped. Now, going back to what the Honorable Court has said, that selective leakage through media does not discharge the company from its obligation to make prompt disclosures. So, even where the information has been widely disseminated but not through official channels, it has to be classified as an UPSI. But in next 10 days, the order of the QJC of SEBI is completely showing the different way. So there are different ways to look at how you take UPSIs. I'll skip this because we all are aware about uh, these regulation 29 regulation 29 says, because they were earlier, there was what was happening, that there were different sort of timelines for giving notice or intimation of a board meeting. For example, for a financial result or dividend declaration, or say bonus buyback, it was different. For fundraising, it was different. For alteration of capital, it was different. 2, 5, and 11, three timelines were there. Now they've harmonized it to at least 2 working days in advance to make sure that there is ease of doing business as well as it is on symmetry. So Regulation 30 is all about disclosure of material events information. Earlier, as I said, that in a year or so, the journey which we have traveled, we have seen materiality being taken over by triviality in terms of A to Z, every sort of, I would say, specifically tax disputes, litigations being disclosed. So now, post publication of the ISF note, in February 2025, we have seen a slight harmonious way of presentation in terms of how Regulation 30 is interpreted. But the very own idea of Regulation 30 is to make sure that a material information, a sensitive information is available to the readers, to the stakeholders, to the investors within the time. So as we said that there was no quantitative threshold earlier, but they have introduced the quantitative threshold of 2 to 5, 2% of the turnover, 2% of the uh, entity's net worth, and as I said that it includes the negative net worth if it is so. Then 5% of the average absolute value. In case of profit, you have to add profit and losses both. So there was a very wide debate in terms of what should be value or expected impact in terms of value. How do I calculate what is to be seen, how it is to be seen? So now they've clarified through ISR that in computing the expected impact in terms of value, a listed entity should, wherever applicable, consider expected impact in 4 ensuing quarters. So, see, there are 4 quarters: April to June, July to September, October to December, January to March. So, if any transaction is taking place within the first 60 days of the quarter, so say uh, we are standing on 26th of December, it means if any transaction is taking place in last 4 days of the December, then this quarter's impact is not required to be assessed and calculated with. But having said so, if any such transaction or any such event is happening within the next 60 days, that is from 1st January to 28th of February, or say 1st of March, if it is happening within the first 60 days of the quarter, then the quarter's impact is also required to be included while calculating the value or expected impact in terms of value. And then you will take the rest 3 quarters. So if it is happening on say 10th of January, so you take January to March, then you take April to December, whole 4 quarters are required to be included in assessing the value or expected impact in terms of value. So what we have to see, we'll have to align it with the accounting principle. We'll discuss this later on. It has to be in line with the generally accepted accounting standards and principles, and you have to make sure that you include the gross amount only for the purpose of disclosures. If there is any indemnity, if there is any insurance, if there is any coverage which has been taken, it has to be disclosed separately, but you will have to see that what is the gross amount of that particular transaction or particular event which is going to be, and which is assessed, which is underway to be assessed for purpose of material transaction disclosures. We discussed already assessment period. So what do you understand by qualitative reporting? Then you have to apply the PPR test in line with, that is probable, possible, and remote. So when I say that I am going to assess the outcome of any event, there may be a case that I'm able to identify the qualitative impact of that particular event. But having said so, whether the outcome is going to take place, that is very important to be assessed. See, for example, if I'm assessing an event which has an qualitative outcome in terms of value, which has crossed my materiality threshold, but the outcome, happening of the outcome, the possibility of happening of the outcome is remote, then whether it should be disclosed, the answer is no, because it is not only qualitative, it is also impact. That is whether the impact is going to be there on the entity or not. So you have to uh, apply the PPR test. If it is in the category of possible or probable, then in that case only you have to, or you are required to take it under consideration. If it is in the remotest or in the remote category, then you are not required to assess. Gross amount we have already discussed, and then a Greek principle, that is redendo singula singulis, which says that in simpler terms, apple is to be compared with apple. So as I said in beginning, we from 2023 we are saying that it is not the lower of 2 to 5, it is the relativity concept has to be brought into place, the comparability concept has to be brought in place. While if you are assessing any event which is having a relation to the turnover, then the metrics within which it is required to be tested should be related to turnover. I would say should be related to revenue parameters at least. So they've specified various standard matching parameters also in the ISF. It is a very detailed note, 43 pager, I think, and one should go and read to understand in detail that what is happening and how an comparable transaction is required to be assessed. We can skip this. Then we all know, if we are aware of this uh, whole journey of LODR 2.0, that the concept of timeliness is so that they have introduced three timelines: 30, 12, and 24 hours. So if it is an event which is coming out of a board meeting, then the disclosure is required to be made within the 30 minutes. If it is taking place after the market hours, then in that case, you have an additional 3 hour time to disclose the same. And if any transaction is required to be disclosed in XBRL format, then you have additional 24 hours. That is what is related to the 30 minutes deadline, I would say. So it is about the critical decisions which are taken in the board meetings. So, and the clock will start ticking from the time the transaction takes place. It comes into the knowledge of a KMP or a designated person, designated person who is designated as an, I would say, designated KMP to designate the information, material information to the exchanges. So the second timeline is 12 hours. If it is emanating within the entity, then in that case, the timeline is 12 hours. Say any major policy change which has taken place. If any decision, any event is emanating outside the entity, say for example, legal notice, I would say, or a rating change, etc., then the timeline is 24 hours. Then I would like to skip this for you because we are running short of time. So this is also very important, and this is relevant to what is happening in the market also. So what they introduced, they said that if there is any market rumor which is there in, I would say, print, public, whatever media, they have defined the what do understand by in uh, media also, mainstream media also. Earlier, uh, prior to the ISF clarification, it was not clear as to, see, there was a very long debates which has taken place as to what is to be considered as a mainstream media. Say if I'm running a YouTube channel, if it is not related to financials or financial market or related information which has been published on that YouTube channel, but for the sake that I'm having, say, 100,000 subscribers or a million of subscriber, if I'm publishing any information, whether it will become an information or a rumor which has been circulated on the mainstream media, the answer is no. We were saying it since beginning, but now it has been clarified post introduction of this ISF node. So what SEBI says that the listed entities must confirm, uh, deny, or clarify. So you will have to do either one of these three. Either you will have to confirm that the rumor is correct. Otherwise, you have to deny or issue an clarification. But whether it is required for any XYZ rumor, the answer is no. It has to be related to a material event, an impending material event that, see, if a rumor is there that A Limited is going to take over B Limited, whether it becomes a rumor, the answer is no. But if there is any such background within which this sort of negotiation or conversation has started or going on, then in that case, the event, impending material event is there. The rumor is related to that impending material event, and it will trigger the market rumor disclosures. Then you will have to see what is the material price movement. So when you see material price movement, so it has been defined that you have to track as an officer or as an KMP responsible for a disclosure or designation of material information, that whether there is any price movement in your share, because it is a very common scenario which will happen. The price will change, so it is an additional duty which I think can be discharged through the use of technology, easier for an entity to track that whether any information is floating within the market, in the mainstream media, or in other domain also, print, public, social media, etc., whether it relates to the ongoing discussions or material events which are there in the entity, and then whether the price movement which has happened is directly related to this. So what is the timeline? This says that as soon as possible, but maximum within 24 hours of the rumor being reported, you have to say. So, what is the significant market reaction, or what is the material price movement? So, the significant market reaction in general refers to a price movement of 5% or more than the 5%. But in the guidance note, already they've clarified in 2023, and it was reaffirmed that the market material price movement of significant market reaction has to be classified in three parts. So if the price of the script is 0 to 100, that is 99 and a half, then in that case it is 5%. If it is 100 to 199 and 5 half, then it is 4%. If it is more than 200, then it is 3%. Having said so, if there is a significant fluctuation in the related index also, the related benchmark index also, for example, if I am tracking any material price movement for a auto sector script, then in case I have to see the auto index also, if there is the movement of auto index is more than a percent upwards, then I'll have to add 1% to 543. And if it is on the downward side, then I'll have to deduct 1% from 5, 4, and 3. So this is how you identify the material price movement. So since we are already running short of time, I'll try to. You will find all these information in the PPT. You can subscribe it online also. So coming as to, and I would like to take next 10 to 12 minutes on what BRSR is all about, because when we started in the beginning, I said that it will be divided into two parts. So elevating governance is something which is the utmost important thing which an entity is required to do. But having said so, there is a case that you have to see that whether the entity is on the path of sustainable growth. The trend is upwards. The trend is showing that the entity is on a path of long-term value creation. So the governance, ethics, transparency, independence has to go hand in hand with sustainable growth. And that's where I would say BRSR plays a very important role in terms of what is to be done. The journey started in 2011 when National Voluntary Guidelines for Responsible Business Conduct was introduced by MCA. Then we saw in 2013 Companies Act 2013 was introduced. Prior to that, BRR, earlier it was Business Responsibility Reporting. Predominantly, it evolved around the NGRBC principles and the CSR guidelines of Companies Act till 2019, I would say. In between, a voluntary adoption for related party, voluntary adoption for integrated reporting was done by the regulator. Then in 2019, it was extended to top 1,000 listed entities, and then came the pivotal point of this whole journey when BRSR was made. BRSR was introduced and it was made mandatory for the top 1,000 listed entities by market cap. So, interesting change which has happened linked to the market capitalization related thing. So, there are many regulations which are applicable on an entity if it is crossing, if it is coming in a bracket of a specific market capitalization criteria, say top 100, top 500, 150, 250, 500, 1000, etc. So, what earlier was the case that you will have to see the market capitalization as on the last day of the financial year, that is 31st March. Based on the same, you will have to assess uh, immediately if you are crossing the threshold of like top 1,000 listed entities, top 100, top 250, then you'll have to apply the regulation or apply the norms from the very next day, which left very less space for the entities to prepare themselves to adopt the new change. So now what they've said, let's keep the cutoff point as on 31st of December. So every 31st December, you'll have to assess that what was the average market capitalization of your entity in the past 6 months, and the list is being published by both the exchanges, NSE and BSE. It is available on the market. Based on the same, you have to select that whether you are falling within the bracket in which a specific regulation will be applicable to your entity, and then you will have clear 3 months to start applying these regulations, because to bring any change, it should be, and it will have to be upside down approach, not the top to down approach. It has to be the bottom up approach. You have to have systems, processes, and a detailed framework in place to implement any new change. So earlier there was no sunset clause. We all are aware, since we are chartered accountant, practicing chartered accountants. Maybe we do practice in tax a lot, and we have heard about sunset clauses in terms of various exemptions given by the government. So there was no sunset clause in case of BRSR, or in case of any framework, any regulation which is applicable per se on an entity if it is falling within a specific bracket of market capitalization. Now they've said that for a continuous period of 3 years, 3 consecutive periods, if you fall outside the bracket of a particular limit of 100, 500, 1000, then you can opt out and you are automatically out of the disclosure requirement. Then 2023 came the BRSR core. Then in 2024, ISF came up with the BRSR guidance, implementation guidance, and on account of ease of doing business, on account of, I would say, reduce the compliance cost. Because when you talk about BRSR, reporting is not complex, but the data collection is very, 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 very complex. So the question lies is, whatever data I'm reporting, the sanctity of data has to be maintained, the integrity of data has to be maintained, and whatever I am disclosing, the purpose is not just to fill the table, is not just to answer the questions, is not just to give an I would say hypothetical answer, or I would say a qualitative answer to a question which requires up to the mark response. The intent is to make sure that BRSR is resonating the sustainability journey of the entity. So you take it in other way, as I call in my other sessions also, when we talk only about sustainability, you understand that you are driving on a hilly road I would say in a very swanky SUV or a very swanky sports car. You have fuel in the same, but you don't have the fuel gauge. You don't know what how much fuel is left. So ultimately, what will happen? You will not be able to foresee that how long you can go, where you have to stop, and what measures you are required to take in future. So leaving you stranded at some point of time in middle of journey, and that is what I think BRSR is all about. BRSR should be the replica of your sustainability journey. The data should be trustworthy enough. The data should match with your financials. Mind my words, it should match with your financials, because the most common problem in terms of the data which is given in BRSR, it is not in line, it is not in sync with the data which is there otherwise in the other parts of the annual report, be it your financial statement, be it other parts of your annual report. So it has to be a case that the data which is given in BRSR is resonating with what is there in the financial statement. Now they said that we talked about reasonable assurance and limited assessment. So earlier it was an it was an it was a staggered approach which the regulator has suggested. They said that for the top 150 entities, 2, 3, 20 to 23 was there, 250, 23, 24, and for top 500, it was 24, 25. You were required to take a reasonable assurance. There was an much, I would say, required discussion about how do you disclose your value chain partners. Now, the relaxation has been given in both contexts. In case of value chain partners, from this year onwards, 2526, it has been made as a voluntary disclosures which is required to made by the company. So now it is voluntary for the entities to disclose their value chain partners on various 68, 69 ESG parameters on which they are required to collect the data in case of assurance. So now I feel that this is again slightly diluted from its own intent. I'm not saying because I'm a chartered accountant, I'm speaking on a forum of chartered accountants that we are the best suited person to provide an assurance on the non-financial data also. And it shouldn't be made sector agnostic, but there has to be some standardized guidance which should be there. So the importance of non-financial data is growing day by day. So what will happen? So you go back and see 10 different sort of assurance reports of various entities on non-financial data, and you will see 10 different sort of approaches followed by different sort of assurance provider, because one, it is sector agnostic. Second, there is no strict oversight. Third, that there is no standardized framework. So when we were in, I would say in the beginning of this year, the regulator suggested that the reasonable assurance or the entity will have an option to choose between reasonable assurance and limited assessment. Correct? So if you have an option to choose between limited assurance and limited assessment and reasonable assurance, then first question came that what does it mean that reasonable assurance, how it is different from limited assessment? Then the onus was on the ISF to suggest the framework or suggest the method, suggest the guidance as to how the reasonable assurance and limited assessment is to be taken place. But the year is over in terms of the financial year 2425, and everybody has published their annual reports, published their reasonable assurance, I would say, for their BRSR if they are falling within the criteria set by the regulator. But still, we are awaiting the standardized framework. So now the question whether reasonable assurance is applicable, whether limited assessment is applicable. If you go back to the ISF note, or if you go back to the ease of doing business recommendation made in February 2025, then you will understand that there is an option which is available in terms of choosing between reasonable assurance, limited assessment. But whether you know that what is reasonable assurance, what is limited assessment, the answer is no in terms of PRSR, in terms of non-financial data. What is the framework? The answer is no. So still we are uh, kind of hanging ourselves in between that what is to be done. And I would say to be on the safer side, to maintain that the level of trust which has been built over the years in non-financial data may disclosed by your entity by the investors, one should obviously will choose and will go for the reasonable assurance. Again, a standardization is required in terms of how an reasonable assurance report and a limited assessment report is to be given, is to be undertaken. Those I told in beginning whether there are any standards, Indian standards which are applicable. There are two standards: SSAE 3000, SAE 3410, which is in place for Indianized context, and there is an other standard SSAE 5000, which is a replica of ED 5000, which is the exposure draft of which has been issued by the Sustainability Standard Board. And it is, I would say, in coming some six months, it will be adopted also. Whether there is any international assurance standard, the answer is yes. There is ISAE 3000, which has been recently revised, and there is ISAE 3410 also, which is specifically for GHG emissions, and why there was a need of having another standard in terms of Indianized context, because post implementation of IFRS S1 and S2 by the international financial regulatory body, it is very important in Indianized context also that we do align our reporting standards, we do align our disclosure standards in with the global framework. So I would say there is a lot to cover, but since we are standing on 7:56, I would at least give 5-6 minutes or maybe more than that if somebody has any other question. So I am done from my side for today's session. If anyone have any sort of question, any query, any practical issue that they are facing in terms of applying these LODR regulations or in terms of complying with BRSR, I am happy to answer. Over to Harshji.
Uh, Thank you, CA Kuldeep, for the insightful and the well-structured presentation. We can might be take up two or three questions.
Okay.
To start with, from your experience, like where do companies commonly fall short in LODR implementation despite formal compliance? Like if you can give some insights from your practical experience.
Hmm. So, say, as I told in the beginning, Harsh, that when you talk about complying with any regulation which is there in unified form, that is, say, take an example of applying the regulation 30, I would say. With due respect, I would like to say that the intent part and the interpretation, two eyes are missing in terms of how do you apply any regulation. And a very well, I would say, appreciated example is disclosure of tax litigations. So when you talk about regulation 30, you will also be aware of the fact that it was the intent was to disclose practical material events which are sensitive and which are relevant for the stakeholders. But what happened that out of 10 disclosures made under regulation 38 were pertaining to minuscule tax, minuscule litigation. For example, if any a 10,000 notice has been given by a municipality, it was disclosed by the woos of the woo. So the intent in some cases and the interpretation, I would say, is something which is missing in terms of compliance, because otherwise there is no other way to adopt or to adhere to any regulation, because it is there the later interpretation has to be taken of that particular regulation. But if we can integrate these two eyes in our practice as a consultant as well as in terms for the companies also, they'll be through easily through these changes.
Understood. Understood. Any practical guidance for CFOs and compliance officers? Like, I am sure a lot of our participants would be at a very managerial role in
Hmm.
the listed entities. So, to strengthen governance culture beyond statutory requirements, like just not for compliance, like if any practical guidance, a short guidance can be given for CFOs or compliance officers.
See, Harsh, it will be slightly difficult to answer this question at this forum, because when you talk about strengthening governance structure, it has to be, I would say, customized one. It has to be specific to an entity, and as you said yourself, that not just for the purpose of complying. So, what a very basic thing which we can avoid is control C and control V. So when you are forming any policy, so any policy, any I would say structure. So when you talk about IFC, when you talk about risk assessment, We do prepare a risk control matrix. We all know we identify risk based on the entity's business domain, based on the entity's exposure to various markets. The same applies to governance structure also. See, don't comply for the purpose of complying, as you said, that if there is a women director or independent director is required, do try to involve somebody in your board who has knowledge of your sector. Do try to form policies. Say, for example, when this amendment came related to material transaction disclosure in June 2023, SEBI gave you like 3 to 4 months. That is, very first or second board meeting, you will have to make sure that you have an amended materiality policy. So, what other entities did? In general, they did control C and control V. Like always, I look up to someone who is bigger in terms of size in my market, and I do control C and control V. But it is not going to help you in all cases, because you have to see what is the nitty-gritties and practical on-ground problems and issues related to your entity, and you'll have to form a policy, be it related to related parties, be it related to material events, specific to your entity. I'll stop at this point only in respect to this question. But if anybody has any specific question related to their entity, they can drop an email to the committee, or maybe they can reach out to me on LinkedIn, etc. We'll try to give an appropriate answer.
Thanks a lot.
But it can't be generalized.
Correct.
I'm sorry to
Yes,
say.
correct. Yeah, I guess these were only queries raised by the participants. Seema, do you want to take it ahead, or?
Yeah, thank you so much, Harsh sir, and thank you so much, Kuldeep sir.
Thank you, ma'am.
Yeah, it was definitely an insightful session to speak. And on behalf of the Corporate Laws and Corporate Governance Committee, I extend our sincere appreciation to our speaker and moderator and all the participants for their valuable time and contributions. Thank you for being part of today's webinar. And so we look forward to your participation in more of our forthcoming programs. Thank you so much.
I would say, ma'am, the special thanks should be to the participants, because on Friday evening, 6 to 8, they have turned in such a large number, and when the holiday season is on.
Correct. And I would like to place on record, we have more than 700 participants online who has joined the webinar.
That is commendable. I think that shows the zeal of chartered accountants. They are still willing to learn new things, and we are on a path of becoming a global powerhouse also.
Definitely, sir.
Thank you.
Thank you so much. Thank you, Harsh sir. Thank you, Kuldeep.
Thank you, Kuldeep ji.
Thank you.
Thank you.